It is FOMC day, ladies and gentlemen. You guys know what that means. We're going to have a live show today covering Jerome Powell and the press conference. How low will we go with interest rate cuts? I'm thinking 25 basis points again, but we're going to have to wait and see here in about 10 minutes, give or take. The bigger question, though, a lot of people are asking is how will the markets respond? In theory, another rate cut should be bullish. Again, we're looking at added liquidity coming into the space. But could this be a little bit of a trickaroo? Could this be a situation where you do see the markets continue to tumble? We've talked about for now a couple of weeks a pullback on Bitcoin being on the table. How will today's FOMC meeting and future meetings impact your crypto prices? Stick around for the entire show. We're going to be here for quite a while. You don't want to go anywhere. Make sure that you go ahead and smash the like button, hit subscribe. But first, we got to roll the intro. What is going on, everybody? Welcome to the Investing Bros. We got a lot going on here. I got two fine gentlemen joining me for today's stream. I got Smay down here in the bottom right with his Pittsburgh hat. I got Tshroom, the co-host over there, hodling on as ever. Smay, I'm going to start with you. How you doing today?
Oh, I'm just doing absolutely swell. I deserve to be well, and I am well. And I've used that line before, because I'm going to keep going for it as long as it's there. So, yeah, I'm very excited. I'm looking forward to this show where we learn about inflation.
That's right.
That
is right.
There we go.
Inflation is on the menu.
I'm going to throw it over to Tshroom, the man who always has a new original answer for the question. Tshroom, how are you doing today?
I'm doing better than I deserve, Tim. I really am. Really, really better than I deserve.
Good.
25 basis points. What we're going to see here. Going to get another cut. Polymarket says it's a 98% likelihood. But there's still 2% chance that we could get something else.
You're telling me there's a chance. We got a lot of people pouring in here already. We haven't even gotten into the details. Going to take a look at some charts here in a second. Prepare ourselves. 2 o'clock. So here in about 8 minutes, we will be getting the live number. What is the cut? Are they pausing? Are they raising? They're going to cut. 25 basis points is what they're going to do. But after that is where it gets really interesting. How do the markets respond to the number? We'll cover that here in just a couple of minutes. Also, then, how will we see the markets respond to Jerome Powell's press conference at 2:30? That being said, before we get going, Samantha, I want to get your take on this. Last take, and then we're getting into some crypto talk here. Got a lot of people pouring in. X already has 270 people on X watching live right now. YouTube already up over 420. How high do you think the concurrent gets, and how many likes do you think we can accomplish during this live stream?
I'm going to give a very realistic estimate. The concurrent's going to get up to 1,300 viewers concurrent. High bar.
How many likes?
And I'm going to say that I want there to be 1,000 likes. That gives a margin of 300 people to be absolute goobers.
Okay.
But majority should like the show. 1,000 likes.
What about you, Tshroom? What are your estimates here for this show today? I think we're gonna have a big house today as we cover these markets. What's going on? What's your prediction?
I think we're going to see 2,000 concurrent, and I think we will get 800 likes.
Yeah. So we're going different directions here. I am going to split it down the middle. I'm going to say 1,700. All right, 1,700.
Wow, I didn't know I was going to be bearish.
I think 50% is about right. So if we had 1,700, quick math, 850 likes is my thought. Let us know who you think is going to be right. Smash the like, hit subscribe, watch the whole thing so our concurrent stays really nice and high. I think we might even get X. I think X might end up getting towards 500, 600 concurrent. That'd be really cool. Let's get in here and see what's happening in the markets, though, and see what's going on over the last 24 hours. Mostly red here today. Penguin making a little bit of a jump back. Of course, that was a big bleeder yesterday, down 50%. It's up now 12% today. Hex is up. Virtual is up. BGB is up. But almost everything else has been bleeding here. It's something we kind of warned you over the last couple of days that this was absolutely a possibility. Bitcoin topping up back here above 100. I almost said 1,800. $108,000 Bitcoin. Yes, we hit that all-time high here literally just yesterday, but now we're starting to fall back down. There's some things that we're watching for on longer time frames that are saying at least back down to this support level. We've been in a rising channel here. We start to look at where smart trails from Luxalgo are sitting. We're seeing this rising level of support and a smart trail on the 12-hour chart telling us 98.5 is something to watch out for. 99,000, that area could be on the table. But if that gets lost, let's just pretend we see something bad happen and we go even lower. We still are on watching radar for a move down towards lower $90,000 levels, potentially maybe even back down here towards 89, 87 area. We, of course, weeks ago talked about 80 to 85,000. That has been lifted as Bitcoin has set a new high since this one set back on December 4th. We also have to raise the floor. The floor being Bitcoin traditionally during this time of the markets has a usually has a 30% pullback. We're estimating in a more mature market, we're estimating 15 to 20% on the table. You're also going to see here the reasons why a pullback could be happening. If you start the daily chart and you're looking at the Lux Algo indicators as well as the other oscillators, MACD here is about to cross bearish, despite the fact that we set a lower high in oscillator and a higher high in price action. If you guys know technical analysis, you'll know that that is what we call bearish divergence. It's not a good thing. Oftentimes means it's time to cool off here a little bit. But even more so, you are seeing the 12-hour chart print our sell signal here. Now, I want to talk a little more about this in a second, but red reversal, bearish momentum, and negative money flow, all of these things are very bearish. I've told you guys that in my back testing, I found over a 90% win rate with this trading strategy. Eventually it works out. There's volatility that always comes into play, but we've been doing some back testing over in our VIP trading group. And some of our members have found that strategy, and I don't know what they tested on, so I have to ask them further questions about the time frames and others. But they found this strategy to push closer towards 100% win rates. That's a high probability. No one knows anything for certain. Things can change. Big events can change things around. But right now, you are seeing some weakness on that 12-hour chart. You're seeing it here on the 8-hour chart with a sell signal here as well. I believe even the 6-hour is under a sell signal. On the 4-hour, we did hit a little bit of support here. So we're kind of in decision mode right now. We already came down after a sell signal. We came down and are bouncing on this 4-hour smart trail. My only concern, as you take a look at, say, the hourly chart, I posted this again in our VIP trading group this morning. Keep an eye on this pattern that looks like it's developing. We have a left shoulder right here. We have a head and a right shoulder. Once again, if you guys know anything about technical analysis, or if, let's say, you're in the Bros Academy currently working through it, we haven't gotten to that lesson yet, so you wouldn't know. But this is a head and shoulders pattern that the way you predict what movement could come next is you take a look at where the neckline is, hovering right here around 103. What's the level, the length of the top of the head down to that neckline? And then if we do get a bearish break with high volume somewhere over here, this alone could send us down towards that support level. Also, that 12-hour smart trail right there around that $98,000 level. And then, of course, after that, we have decision time. Do we bounce? Do we use this as support? Or do we lose it and head down towards or below $90,000? That's what we're watching happening right now. But, of course, on today's show, everybody is keeping their eyes on what's going to happen with the FOMC expectation. We're going to be dropping to 4.5%. Right now, it's at 4.75. We have CME futures predicting with a 98.6% chance. So I know Tshroom earlier said there's still a 2% chance we pause. Well, CME says there's less than 2%. 1.4% says we can pause. Everybody else saying 425 to 450. Looks like it is coming here in literally about 1 minute. So we're going to keep an eye on this screen right here. But really quickly, I'm going to throw it over to Tshroom, get his take. What are you expecting here in literally less than 1 minute, Tshroom, from this interest rate cut or potential cut?
I am. What am I expecting the markets to do?
Yeah.
You know, they've seen a little bit of a correction today. So pulling back on the crypto as well as the indexes side. So I'm guessing that there's probably a resumption to the upside and the uptrend, the bullish trend that we are in equities, in crypto. And here we go. There's an official announcement. Fed cuts 25 basis points as expected from zero hedge there. just 14 seconds ago. So let's look at the charts. Let's see how Bitcoin's reacting in the first couple seconds here.
Let's get a quick reaction here. It looks like, we'll go to the 1 minute chart to see this. It looks like an initial sell-off, a little bounce back, clearly increased volume here on the 1 minute chart for the last couple of hours. But a sell-off does look like it's on the way. Now, I want to prepare people. This does not mean that we're going to have a massive crash automatically. I know I just gave you guys a lot of analysis on higher time frames saying that we probably still have ways to go to the downside. But something to know, if you're newer to trading crypto, if you're newer to how FOMC meetings operate, there's a whole lot of volatility. I would tell you guys what you should be on the lookout for is for the prices over the next hour and a half and possibly next 24 hours to look like this. Like, don't be surprised to see a whole lot of bouncing. And for more on that, let's kind of take a look at some levels here, which we didn't get into, but let's look at some levels where we have support, where we have resistance. I'll start with this one, the neckline, very clearly here at 103.27. Don't be surprised that we touch this level. The question is, can we hold it, right? If we break it and start to go to the downside, especially with higher volume, all of a sudden that 98,000 becomes increasingly likely that that's the level we hit. But you could definitely see 103 be used as some level of support. Some other levels to keep an eye on if we do start rallying. We have a big breaker block up here around 105.6. Again, that's kind of those same peaks as the left shoulder here back on December 15th. We could rally up to that level. So we're kind of watching and saying, do not be surprised if Bitcoin during this live show stays in this range of volatility where it could drop to 103, it can rally to 106 almost, but ultimately no big decisions are made. I will say, if we do get a big breakout above 106 and we start to get some high volume, well, that could be a very, very good sign, in which case now all of a sudden you're looking for another move to the upside and possibly new all-time highs back up here over 109 to this trending level of resistance. That absolutely is on the table. I don't know if it's very likely, but that's what you're looking for. And then, of course, as I said, if we do see a major drop to the downside and we lose 103.2, well, there will be a little bit of support here at 101. I'm expecting the next level to watch for support, major support. We're going to have to decide what happens around 98.5, give or take. Let's take a look at liquidations here as well. What are traders kind of watching right now and saying is on the table? A lot of what I just said is being backed up by what liquidations look like. Look at where all of the short liquidations would be liquidated up here at where? That 109 area. We just talked about the level of resistance. Guess where a lot of liquidations are to the downside? They're sitting right here at 103 where we have some major support. And if we trickle on through those levels, it could be, again, a big fall, at least, again, towards 101, but 98 is there on the table. So this is still our range. This is still our pocket right in here between 105 and 103. But if we start to make moves, you do see some massive liquidations to the upside and the downside that traders could look to take advantage of before the next big move does happen. That being said, let's take a look at some other coins and take a look at what other things are doing. Let's look at what's some bigger moves here today. Let's take a look at XRP. A lot of people have been following XRP here. If you're an XRP army member, if you hold a good size bag, put a 1 in chat or put an X in chat, letting us know you are here. You're kind of seeing a similar type of movement here on XRP. It's not as easily identifiable. Is this the neckline right here? Because it looks like that could be a left shoulder, clearly ahead, but is that the right shoulder? Are we still working on the right shoulder? Kind of an ugly looking head and shoulders pattern, but more importantly, let's take a look at what we have with longer time frames. Let's start with a 12-hour. That was what we're witnessing with Bitcoin. Are we getting buy, sell signals? How are we feeling when it comes to the oscillators? You can see this money flow has been continually moving to the downside. We have reversals in play here. Technically, a sell signal on XRP launched back here December 8th. Since that time, XRP has been a little volatile. It's hit a little bit higher, but it hasn't set a higher high during that time. Where would we say we have to pull back to if that was the case? Pulling back down here towards $2.10 could still be 210 to 201 could be on the table here. But this one, I'm not necessarily as confident. Again, Bitcoin kind of printing these sell signals within the last couple of hours. XRP definitely seems like it is kind of deciding, does it want to go up? Does it want to go down? Levels I would keep my eyes on today during volatility here for XRP. Let's head back towards 1 hour and see what's going on. A recent sell signal does suggest a move back down here. If you were to extend this former resistance level as support, I would say this is going to be an interesting spot around 235 to keep an eye on. We could drop down here very easily and get a good bounce. If we lose this level with heavy volume, all of a sudden we're talking about $2 coming back onto the table. But right now, that's where I would keep my eyes down to the downside. To the upside, I like where this smart trail and these order blocks are, somewhere around 260. Looks like our move to the upside to block. So you're kind of sitting here watching with all the volatility. Again, we could make a move down here to 235. We could make a move up here to 260. But until we break out of that pattern, this is simply volatile trading movements that don't mean a lot. Look at where we have liquidations trickling down here to where? 235. An interesting spot here at 260. Technically, some interesting liquidations here at 274, but there's a little bit of break here after 260. So that liquidation chart is backing up our support and resistance levels. Do not be surprised to see some increased volatility. Let's take a break from the charts here for a second. Let's go back to our multi-viewer screen. We're going to hear from Jerome Powell here in roughly, 24 minutes or so. We're going to cover all of that live. We're going to let you guys know what is happening. We tell you guys this before. Smed, you can go back to our split screen here. You can go off my screen. But we told you guys this several times before. If you've ever watched one of our live FOMC meetings, the number that gets said, unless it's a shocking number, unless there was a lot of debate about what the cut or the raise or the pause was going to be, that doesn't mean a whole lot. What's most important is, how does Jerome Powell speak about the future? Is this cut risky? Is he regretting it? Was it unanimous decision, or were there people in the Fed starting to say, you know what? We need to consider pausing. Of course, recently, inflation numbers have gone back towards the upside, not dramatically, but slowly. So what's going to happen in that press conference? What is his opening statement? He's going to probably sound confident, but how confident does he sound about how the economy is going? What does January hold when we have the next FOMC meeting? And how confidently does he answer the questions asked to him by the press? Tshroom, I want to get your take on it. What are your expectations here in about 25, 26 minutes or so from good old Jerome Powell about what the future holds for the American economy?
I mean, I think he needs to answer the big question, which is this the last rate cut that we're going to see for the next 6 months? Is this going to potentially be the ending of the easing cycle, as Zero Hedge is calling it already 3 minutes ago, saying the Fed's easing cycle is over? We do get the SEP with this announcement. I haven't pulled that up, but that's the Statement of Economic Projections. And, we'll get a fresh dot plot. We'll see what the Fed FOMC board is thinking interest rates are going to be into the future, into 2027 and in the longer run as well. Yeah. So that'll be very interesting to observe. But I think the big one that the market is, at this point, you're not saying it's a heavy sell-off, but the NASDAQ's down. You're moving, it's not even down 1%, so it's not decisive. Crypto is still overall kind of down today. Bitcoin down 2.3. Ethereum is down 1%. So, I do think that the market is starting to potentially react, saying, hey, this could potentially be the end of the easing cycle. Rates are going to stay parked now at, what is it, Tim? 425 to 450.
Yeah.
Is that what we're going to see into April, March, the summer, July? Are we going to get to August and rates haven't moved? Mm-hmm. That's not necessarily the end of the world, but that's probably not what the market has been pricing in, with the S&P, the NASDAQ, and Bitcoin hitting all-time highs month after month in the second half of 2024. So, that's the big question that I want to hear answered is he going to give any kind of indication? They follow the data. Well, inflation data has been pretty hot. PCE, has been hot. PPI, CPI, all of them have come in a way that you could easily interpret. You don't need to be some, tenured economics professor to interpret each of those as, something that the Fed may consider cooling off their cut policy here, their quantitative easing, cooling that off. So that's an option that Jerome could take. But we could get to January, we could get to February, and they do continue to cut as well. I'll be listening very intently to that guidance. And also, what will they'll do with their balance sheet as well? Will they continue to onboard and fill their balance sheet, which will be good for the markets, or are they going to potentially not do that anymore? So those are the things I'm looking out for. Jerome Powell, this should be an easy one for him. The general sentiment is that this isn't that important, right? The fact that we got a cut is great. But now it's like, okay, it feels like any month now is going to be the last cut, and they're just going to park it at what they consider to be significantly restrictive, right? To keep inflation at bay.
I'm gonna disagree with you a little bit on one of the things you said there, where you said this should be easy for him, right? I don't think this is gonna be an easy press conference for him. Again, remember, recently we've seen both inflation tick back up and unemployment still show us signs that it's not doing great. Some people might say the unemployment numbers are fine. There's that argument out there. I'm gonna make a counterpoint. Historically, and we saw this happen last year, right? Historically, quarter 4, because of holidays, jobs, especially part-time jobs, really skew the numbers on unemployment rates and things going on. We are not watching employment rates be favorable right now, despite the fact that we are about to end quarter 4. And throughout all of quarter 4, those numbers have been a little alarming. So when I say I don't think it's going to be easy for him, what I'm saying is I think he's going to get grilled with some pretty hard questions about what the future holds. And I think we all know, or those of us who have been watching him for a while, he doesn't like to show his cards. He likes to be a poker player. He doesn't want you to know what he's actually thinking and what they're doing in the future. But he's going to get grilled with some questions on what the future looks like. And at the moment, I don't know if he's going to have all the data and information he really wants to have to give us an informed opinion. So I'm going to be interested to see, at any point, do we see him squirming? Do we see him uncomfortable with the question and not liking he's not going to want to say, guys, the economy is in trouble. All of a sudden, he then causes a panic and the markets start to drop dramatically because people are in fear of a massive recession, right? He can't say that. But he also doesn't want to say, oh, everything's okay. And then all of a sudden next month, inflation gets out of control, unemployment gets out of control. Then we actually hit a recession. And he was the one who just a couple of days ago was like, oh, everything's fine. He doesn't want to be that guy either. So the line he has to walk today, it's very thin. It's very dangerous. And so I don't think today's an easy press conference. I think last couple of months were good. When inflation is down, when unemployment's not really out of control, and you can cut rates, that's an easy meeting. He had that a couple meetings ago. I think today we're getting back into the hard stuff. I think we're getting back into the challenging chess playing. How do I politically answer these questions without causing too much FOMO or too much fear and look like a complete idiot while doing it? Update here, there is a chart moving quite dramatically since this announcement came out here just 13 minutes ago. Go to my screen here, Smay. It's the Dixie. It's not the one you necessarily want to be climbing here. Now, the percentage here isn't anything to write home about, right? The Dixie, since the announcement, is only up 0.63%. But for the Dixie, that is absolutely monstrous. Look at the volume coming in here. This is communicating the power of the dollar. Now, something to be aware of about this to me is a little bit of kind of backs up some of my thoughts beforehand, is that while we were going to get good news about the cut, and again, this should add liquidity, there were people waiting on the sidelines. There were whales, there were institutions, there were experienced investors waiting on the sideline to say, you know what? We're overextended right now in a lot of markets. The stock market has been overextended for a while. Bitcoin especially is overextended. A lot of crypto is overextended. So let's wait for some good news and then do the exact opposite of what people think is going to happen. This news that we're going to cut rates again, add liquidity, weakens the dollar. This chart really should be moving to the downside. Again, when you look at the Bitcoin chart, added liquidity, more people willing to buy. This chart should have been moving to the upside, and yet we're dropping. We're getting close to that range. Remember, I told you guys earlier, we could fall back down here towards 103 and still have support. We did kind of just that, falling to 103.3. The markets are kind of doing the opposite of what intuition would say it should do, or the way a simple investor would think it would happen. This, to me, is a sign to keep an eye on about potential manipulative movements where they're going to set up a lot of bull and bear traps. They're going to convince you to go all over the place. They're going to drop the price, scaring you. All of a sudden, you want to sell. Next thing you know, they're going to start pumping the price. And then the minute you become more confident and you buy back in, they're going to start dumping the price. What I'm watching here today is kind of a predictable manipulative movement because a lot of people, you guys watch our channel, so a lot of you guys are probably chart people. You should not be fooled. We've been watching this chart be overextended. But I think, and Tshroom, tell me if you disagree, I think more people trade crypto and trade markets based off of news and sentiment than they do trade it based off the charts. And so a lot of things are bullish right now in sentiment. A lot of news is bullish right now. So a lot of people just continue to buy. It's only the people that also incorporate charts into their trading and investing information that are sitting here saying, yeah, this move to the downside is not surprising whatsoever. It's been something kind of overdue, something we've been looking for a while. And that's the people that are getting wrecked. Again, you guys should not be getting wrecked right now. You've been looking at the charts with us day in and day out. This does not surprise you. But there are millions and millions and millions of investors who never take a look at the charts, or they don't know how to read them. And they're the ones getting absolutely obliterated right now, thinking this information should have been bullish, but everything seems to be moving to the downside at the moment. Tshroom, tell me, do you agree with that take? Do you disagree? What are your thoughts about what we're watching right now with a lot of these risk on assets or risky assets falling, despite the fact that this news means added liquidity to the markets?
Yeah, I think the number of people that are trading, and trading is kind of a tough term to put a definition on in the context of this question, but people that are entering and exiting a trade in any given day, I think are not necessarily basing that off of price action. They're more than likely just basing that off of they heard a headline, right? Or they had a conversation with an uncle. And that's just because I think the majority of people have a job, right? The majority of people have things they have to do, whether they're a doctor, a plumber, or an astronaut, right? They have to study their craft. We know a lot of people in our neck of the woods that day trade, right? So all we do is look at the news, look at the charts. But I think that's still a pretty small group of people compared to the hundreds of millions that live in the United States and compared to the billions of people that live globally who are doing a job. So I would say that people are looking at the news more than they're looking at the charts. And, that is a recipe to be manipulated, especially by the media. But make no mistake, market makers can absolutely manipulate the information that you can read on a chart. But here at the Investing Bros, we like to think that we've actually cracked that code as well. And we know when the manipulators are manipulating. It sounds like 4D chess. It's really a lot more simple than I'm making it sound here. We get it all delivered to you in our Discord. If you actually go to my screen, Smay, you can see this is the link. So this is the video you're watching right here. Just scroll down, smash the like button on your way, and go to the BroLux membership link. And this is where you can join our community of traders and investors and invest in your trading future and your investing future as well, if you so choose to take this daring path. Discord right here, this link, this is where you can join our free Discord, where you can come in and ask questions, whether they be experienced questions, like something specific about the RSI being overbought or underbought, or something, a beginner, like what is a good exchange to use when getting into crypto or trading stocks. So we'll answer anything and everything in that free Discord. But if you're ready to take that next step and take it seriously, go ahead and jump into this link down here to sign up and join a group of committed and mature experienced traders and investors.
Really quickly, if you guys are just joining us, welcome to the Investing Bros Live Show. We're covering the FOMC meeting live here in about 12 minutes. If you missed the announcement, we did have another 25 basis point cut as expected, and we're monitoring right now. Nothing is free falling, right? The sky isn't falling, but prices of crypto, you would think with another cut should go to the upside. They have dropped back down. The Dixie, you would think that with a weakening coming to the dollar, making it easier to borrow money, you would think the Dixie would fall. It is rallying. We're watching the opposite of what intuition would say should happen. We're watching the charts play out the way they should. And again, Jerome Powell will be live here to answer some questions in just over 10 minutes. But let's go to some Q&A here. Let's go to the chat, see what you guys are talking about, and answer some questions. What are you guys looking at? What are you concerned about right now? I see some people addressing the challenge. There's a challenge for 20 super chats of $5. If it happens, Smay will sing at the end of the show. Smay, do you have a song picked out already for if you end up having to sing at the end of the show?
Well, Tim, this is the first I'm hearing of the singing challenge, so I will have to have that prepped. But I have a few things that I can pull out, of
Got a couple.
the bag, But yeah, no, sure, I'll sing.
Very nice.
Cryptocasian says, bro, no cut. Stayed at 4.5. That's actually not true, Cryptocasian. So what it was before was 4.5 to 4.75. It has now been moved down to 4.25 to 4.5. So there was a cut. It did, in fact, happen. Let me make sure. I mean, for some reason, if I'm saying that crazy. Yeah. So if you look at my screen here, show my screen, Smay. This is what they take the higher number, right? So if you were to look at this one, excuse me, the expectation here, staying paused would have been 4.5 to 4.75. A breakdown 425 to 450. I know it's a little confusing. That is crazy, but yes, previous level was 4.75. Expectation was 4.5 with the 25-point cut. That's exactly what would have happened there. So hopefully that answers your question, Cryptocasian. If you misunderstood, what else you seen in chat there, Tshroom, that we can answer?
Well, there's an update here from Zero Hedge. Take a look at my screen here. This is really interesting. Zero Hedge said the Fed admits translation, the Fed admits it's inflating away the 36 trillion in debt. And the punchline, kiss the 2% inflation target goodbye forever. Now the question is, when does the Fed admit that 4% inflation is the new baseline? Zero Hedge circling this line item on the newly issued SCP. And this is interesting. Of course, this is one way out of having $36 trillion of debt, is that you just print more money and pay it off, right? Pay off those bondholders. However, the consequence of that is higher inflation. Could we be moving into an era where for the first time the Federal Reserve says, hey, that 2% inflation target rate that we've had since the inception of our institution, we're going to now double that and expect inflation to hum at 3 to 4%. That would be very, very interesting and a very strong reason to buy gold, buy Bitcoin, get out of dollars.
What's the exact level right now? Is it 2.7? It went up to 2.7, or is it back above 3%?
Let me take a look and make sure that I'm getting it right here for you. Good question.
But if you're new here, while Tshroom's looking it up, remember when it comes to the Fed, there's a dual mandate they have to look at. And they're responsible to try to keep inflation low. And they vocally have said several times they're trying to keep it at 2%. That's their target, right? What Zero Hedge is calling out is that that's just not possible. And at some point, they're going to have to just wake up to that. But they're also monitoring unemployment. And so you might be saying, well, if we're not at the 2% target, why are we cutting rates at all? And it's because they've seen some concern with unemployment. And that's going to be Jerome Powell's worst nightmare, is if we see both unemployment and inflation rally at the same time, come back to the upside. All of a sudden, he has to pick and choose. And my horses are on that he tries to tackle unemployment before trying to get back on top of inflation. This is a very good thing for crypto long term. Again, if inflation does bounce between 3 to 4, and that's the new normal, new expectation, who wants to keep their wealth stored anywhere close to the US dollar that's inflating by 3 to 4% every year? Whereas when you look at Bitcoin, that is a very strong, firm, solid place to hold your wealth and is showing increases. What's the exact? There was a report out a couple weeks ago. What's the average return on investment for Bitcoin? Let's just even say the last 5 years.
Well, that's a different question. I've got the answer to the first question here.
Yeah, go ahead.
2.7% is the answer to the question. I've got a chart as well. You can see how we've arrived here over time. 2.7 is where we are hanging out right now. We were actually lower. We were at 2.4, and then there was an uptick. This is headline CPI, by the way. There's other measures of inflation, PPI, PCE. But back here, this is 9.1 was the peak. Back here, this was the consequence of the spending during the pandemic, and that was 9.1. We probably won't see that again outside of a black swan type of context, but we could start to see the new norm of the Fed's mandate actually get revised up, either de facto or formally, to go and exist within this target range of 4 to 3%. Now, that doesn't sound like much. That doesn't sound like a lot, especially if you're newer to investing, newer to trading. You might say, who cares? 3 to 4%. That is a lot. That is quite a bit. If you are a average American consumer, that is an insane amount of inflation to be debasing your currency. It is all but a red flag, a white flag rather, of the Federal Reserve and the U.S. government in general saying things are falling apart. We're having to move the goalposts. Of course, this is not 100% confirmed, but we could hear in 2025 a formal presentation by a Fed representative, probably Jerome Powell, saying, hey, we are having to revise up our inflation mandate. It's just a possibility. That would be pretty unprecedented. So I'm not saying it's definitely going to happen, but Zero Hedge is kind of insinuating that could potentially see that.
Yeah, that's absolutely true. Let's go to chat here. Matthew, I think there's some other people in the same. Oh yeah, Paul Bruner. A couple people asking, what about Link? Talk about Link. Let's go take a look at the Chainlink chart, and I'll start off on the weekly chart where we told you guys a little bit ago we got to 100% overbought on RSI. We got the RSI up here towards 76 in what we call technical overbought position, but we still see a lot of strength in the MACD. With room to the upside, no bearish divergence here. Strength continues week over week. If you look at the Luxalgo oscillator, red reversal came in, but the money flow still flowing up. The oscillator has not printed bearish momentum just yet. So no sell signal there. So there's hope that we could go higher. We have hit the take profit levels on the weekly chart from the buy signals, but where you start to get some concern, you move down here towards the 2 daily chart. Now you're starting to see, all right, well, it does look like we have bearish divergence in play here. It does look like the MACD is starting to make a turn, maybe head south. Red reversal, bearish momentum, bearish divergence. That money flow it's hard to read. We need to see the 2 daily candle close to be certain. But absolutely, as it's looking right now, it's starting to head to the downside, right? So on the 2 daily chart, if that does flash sell, all of a sudden Chainlink's looking for a pullback down here towards $22 to possibly $20, give or take. We are starting to see the daily chart. In fact, we got a sell signal on the daily chart not that long ago with a bearish divergence here, bearish momentum, and negative money flow. So we got this yesterday a sell signal flashed. That says $22, $23 should be on the table for a Chainlink pullback here. So these longer time frames, absolutely saying that Chainlink is overextended, probably needs to cool off. Nothing crazy. Again, this weekly chart, not bearish. To me, is that when you're looking at the weekly chart in the future, it'll be a blip on your radar, maybe 1 or 2 blue candles before it continues to the upside. But we're not talking about a move back down towards $10. We're not talking about a brand new bear market move. I think what we're watching for is maybe that 2 daily smart trail around $20 to be the floor here. Not guaranteeing we go that low. I'm just saying that's the floor on a major pullback. After that, we do continue. On these low time frames, let's look at the hourly chart because we did establish some shorter term moves here. We are under a sell signal and a rejected on the smart trail. We got some targets down here at 25, as low as 24, but let's focus on 25 here for a target to the downside. Pull up some liquidity. You don't even have liquidations down there. The main liquidations to the downside only here on 26.2. If I turn all of this off, you also can see kind of a descending trend has been in play here for support. So keep an eye on this as well. That trend line to the downside will play a major role as support. If we break with a lot of volume, all of a sudden that $20, $23 to $20 range becomes very interesting. But for now, with all the volatility that's going on, I wouldn't be surprised to see a bounce if we fall further to this red line. To the upside, liquidations-wise, I'm really going to watch probably up here. I think there's going to be pressure if we push the upside back up above 28, but then you could see volatility where that gets rejected. So keep your eyes on those levels as well. That would be a break above the smart trail, and we have to change some things. We probably have a buy signal in there, but for now, let's use that as our range. 28 to the high level, and then 26.2 for the lower levels on Chainlink during these ranges. Longer term pullbacks to $20 on the table for Chainlink. Guys, it's 2 minutes out until we get to Jerome Powell Live. Please make sure to smash that like button. Right now, we have over 550 people here on X. We're not looking at that, but we're going to make sure those people are smashing like as well. On YouTube, over 900, but a lot of you guys are probably waiting for Jerome Powell. 372 likes, okay? So we got a lot more likes to get to. Again, I'm expecting, I think Tshroom said 2,000 concurrent. I said 1,700. Smay said 1,300. Don't make Smay right, guys. Don't make Smay right about this prediction. Let's get some more viewers in here. Let's get some likes put in. 'Room, closing thoughts before Jerome Powell comes on. He's probably seconds away from taking the stage.
Yeah.
What are
So
your
we've
thoughts
got
here?
the dot plot here. Let me break this down for you all. This is the projected interest rate for the United States interest rates set by the Federal Reserve. Now this is September on the left-hand side of the screen. December is the one we just got printed. This is what all the dots per year represent what the different Fed board members believe the interest rate will be on average throughout that year. Okay. So in summary, they think that that interest rates will actually be higher in 2025 than they thought in September. Now, what I will say, it is a pretty slight increase. Okay. So first of all, the highest dot only went up 0.25%. It went from 40 to, 4.0
Here he
to
comes. Here he
4.25.
comes.
So very modest gain in September to December.
Here he comes.
All right.
Good afternoon.
Oh, no sounds, May. You got sound?
I'm working on it.
Yeah, the first couple of seconds is not the most important part. But yeah, we're going to keep tracking how things react to Jerome Powell here as well. So far, positively.
Here's what you missed. Good afternoon.
Oh, man. We had this working right beforehand.
Let him cook. Let him cook, Tim.
Let him cook.
If anybody can get it right, it's Smay.
Oh, no.
You need us to go a different direction here, Smay?
Just tap dance for me.
Well, I don't think anyone could hear or see the skills of my tap dancing whilst we were live. The other thing is, Ian, could we share maybe possibly a second form Tshroom screen and share his sound?
Yeah, we can try that.
Okay.
Yeah, let's try to get that up there. This is the elf's revenge, says wrong again. Possibly. The elf in there playing some problems. Smay taking credit for all of his work.
All right.
Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened.
Is that
A summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid.
Is it pulling through
Payroll
the audio?
job gains have slowed from earlier in
I
the
can
year,
hear it, so I can't.
averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina.
Gina Smilik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
First question.
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people. The way I would say it is this: some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. And, you know, the point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down. And so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track. But, you know, once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still, you know, going to be between 2.5 and 3. It's way below where it was. But, you know, we really want to see progress on inflation to, you know, as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
So no cut in January.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, you know, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And you know, there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, you know, that considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, and you know, it puts us in position when we finally do see what the actual policies are to make you know, a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how, you know, prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And you know, so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be you know, retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. there was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but it would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So,
great question.
The rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policy so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, we made, if you look at the broader sweep, we've made just a great deal of progress. We're well into the twos in core inflation and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago. But it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on. And, our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So you're right, though. And I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think, you pointed out, participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market. And it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation is moving around by a tenth every few months, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are we think are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
No cut in January.
Thanks, Chair. Chair Powell, Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of just take the last year, We've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Bitcoin.
Andrew.
Ding, ding, ding.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is, do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so. No, I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand, and it has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation, and that's part of the reason that explains why we moved ahead today with the action with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira.
Thank you, Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. nonetheless, it's one of our mandate goals. And, we pay close attention to it, and it's worth noting that it is still gradually cooling, gradually and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to had a deep recession and, high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices. And that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there so that people are earning, big real wage increases so that their wages are going up. Their compensation is going up faster than inflation year upon year upon year. And that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration? I feel
very good about where the economy is. Honestly, I'm very optimistic about the economy. And we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes? Where is that neutral rate?
So I'll say a couple of things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting, but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place. But I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation, because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy, and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be, because it's a better measure of what inflation pressures exist. So that's it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down, but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
So we monitor geopolitical risks really quickly, but really carefully rather. But
yeah, really quickly.
I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, So inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation. And it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly
this is a long press conference
now.
Yeah.
And we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
Hardball question.
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now. And we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time. And those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong, though, that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track. And I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
About time to have a last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways, appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. And I am confident we will achieve that. It has taken longer, but you have to be. We are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
All right. We go ahead and cut that volume. There we go. Longer than usual press conference. Normally, I think I've seen one go to like 3:15. That was the longest I think I'd seen one go. This one at 3:23. I'm going to be very honest with you guys. In case you guys weren't watching, just listening, I was watching charts a lot. I definitely listened to some things he said, but I probably didn't catch as much as Tshroom did. And before Tshroom even speaks, I commented this in chat. So you guys are reading chat, you heard this. I don't think the prices were necessarily responding like to Jerome Powell. Like there were times where he was saying things that I was kind of processing. I'm like, oh, that's not great, but the markets were boring or moving up. And there's other times where he said something that was good and the markets were moving down. I'm gonna be very honest with you guys. I still want to break down what was said and what you can take away from this, some of the biggest things here, and then we'll wrap up the show in a handful of minutes. I don't think this had anything to do with Jerome Powell. I don't think the markets. I think this was a grand excuse. We have been saying for days now, weeks, in fact, that the markets were overextended and needed to pull back. I should have guessed, if we're being honest, I should have guessed that they would use a situation that people would perceive to be bullish or big to be the excuse for liquidating a lot of this stuff. But I was explaining to you as things were going down, kind of with my comments, like what's going on here. These are targets. Let's zoom back out. We spent a lot of time on the 1 minute chart, but these are targets we have been talking about here for a while, right? Even before the show, if you're just joining us, welcome. So glad you guys are here. But we talked early in the show. Anyone who has been here the whole time, correct us and tell us if we're lying. We talked about 98,000. We talked about moving back down towards support level. We talked about on the 2 daily chart. I know I put the 1 daily smart chart. We talked about still that potential chance for lower 90, possibly even down below $90,000 for a pullback. All of this before we heard a single word from Jerome Powell. We've been saying this for a while because this is what the charts are reflecting needs to happen. Now, I will say it makes sense that alts are bleeding as well. One thing we need to check on here, and then I'm going to throw it to Tshroom, Bitcoin dominance with some surges here on the daily chart. Let's go to the daily chart here. Daily chart yesterday closed at 57.98. Right, I told you guys what makes me concerned about this chart is if we sustain a whole day above 90 or 58%. Right, so we're still in control here. We still have a smart chart rejecting us. We'll see what kind of happens. Again, a lot of drama that just happened within the last hour and a half or so with prices crashing, alts crashing a lot. I think you could see alts bounce back faster than Bitcoin, and then all of a sudden this Bitcoin dominance chart starts to drop again. But if you're wondering, hey, we got above 58, does that mean altcoin season over? No, it doesn't mean altcoin season is over. And I'm going to probably make a video today or tomorrow. So I'll make a video going out tomorrow morning or the morning after about my thoughts on altcoin season. I've seen a lot of confusion and questions about altcoin season. So I'm going to kind of clarify some stuff there. But if altcoin season is canceled, what I would need to see is a sustained whole daily candle, both open and close, above this smart trail, around 58.5%. And that would then be a concern to me that we potentially are going to see Bitcoin dominance start to rally again. That being said, I want to make sure people are aware here. That would be a breaking of cycles. That would mean that this one's different, which is fair. This whole cycle has been different. But that doesn't mean that all of a sudden altcoins are crashing and Bitcoin's going to go the upside. No, I mean, there's a world in which Bitcoin just rallies ridiculously fast, really, really high. Altcoins rally too, just not at the same pace, and the Bitcoin dominance chart goes back to the upside. So Dips Survivor said, who said it's canceled? I'm not saying it's canceled, right? Let's be very clear. Tim is not saying that altcoin season is canceled. What Tim is saying is if we are going to say it's possibly canceled, I need to see this smart trail get broken and a whole daily candle close up there. But at the moment, I'm not saying that, and I think it's a little foolish to say that as well. This is simply, at the moment, the potential of a lower high in a changing of a trend for Bitcoin dominance, where we've been rallying for so long, but I think we're witnessing the beginnings of a pretty decent-sized fall between 50 to 45%. But I'm going to throw it to Tshroom. Christmas is not canceled, Tony. No one cancels Christmas. Tshroom, you were paying a lot more attention to the actual interview. I'm sure you are tracking what a couple of people are saying over on X. Let's break down some of the biggest moments and thoughts from Jerome Powell in this press conference. By the way, 1,100 concurrent. So not even Smay was right with his 1,300 prediction. Let's get some more likes. Let's get some more people here as we wrap the show out, and we kind of wrap this whole thing into a bow. But more likes, more people. Hit subscribe if you're new, by the way. We just hit 38,000 subscribers. Let's get to 40,000 here very soon. Tshroom, take it away. What are the thoughts here?
Yeah. Well, first of all, folks, I've been seeing folks comment about the, alt season being canceled. You know whose interest it serves for rumors of alt season to be canceled? The interests of whales that want to buy altcoins lower. They're seeing the altcoin season kick off and prices move higher, and they're not positioned to be able to gobble up as much altcoins as they wanted. So that's what is coming to my mind when I'm seeing these rumors circulate about alt season being over. I'm seeing nothing that is telling me that. What is the main reason that I don't think it's over? Ethereum has not breached its all-time high.
Yeah.
Until Ethereum gets to its all-time high, we have not seen even close to the end of altcoin season, and that traditionally marks the beginning of altcoin season.
That's not when it ends. That's when it gets even spicier.
Right. So a couple of things here. The biggest takeaway is I think we saw, seeing markets pricing to the downside ever so slightly, right? What does that mean? In the market, we use a term called it was baked in, right? This cut was absolutely baked in. There wasn't really too much movement. The bond market, however, did see a rise in yields coming up. What does that mean? That means that folks are going risk on. At least if you look at that metric alone, you're seeing yields go higher. At the same time, the stock market, equities, as well as some of our crypto names here coming down. What does that mean? That means they're going into cash. And that makes sense because the Dixie is moving higher. Going into cash temporarily. You don't stay in cash in a bull market, but you do sell bonds, allow that the yield to come back up, and you rotate that cash into risk, whether that risk is going to be chasing Tesla higher, trying to buy Microsoft or Apple or Google at a somewhat attractive prices, or buying Bitcoin and rotating into altcoins, or buying up small cap tech stocks. A lot of tech stocks are vastly undervalued if you compare them to Microsoft and Bitcoin and some of these other more popular stocks that are at or near their all-time highs. So those are my thoughts. Altcoin season far from over. But the market is starting to has priced in and is starting to reconcile with this likely being the last cut we see for this cycle, for this phase, until something else happens, right?
Mm-hmm.
We're kind of just like treading water here. The Fed is just kind of like, hey, we're seeing inflation kind of stay put around 2.5. That's not our target, but that's also not the end of the world. It's actually pretty good. We've made a lot of progress. What's 0.5 between friends? We're basically at 2%, right? So they're happy with that. They're looking over at the labor market and they're like, it could be a lot better. So we're gonna go ahead and have a jumbo cut in September and then 2 more 25 cuts, and that brings us to the present. I think in January they don't do another cut and they just wait and just kind of see how these cuts permeate into the market. Do they end up lowering mortgage rates, credit card rates, auto rates, or do they need to cut more in order to give Americans a little bit more of an easement in their pocketbook? Okay, so I asked Grok, what do you think is going to happen? Grok, if you go to my screen here, said, given these factors, and I fed it some data, given these factors, the most likely decision by the Federal Reserve in January 2025 would be to hold interest rates steady. And it gives an explanation why. Polymarket going ahead and pricing in, it hasn't broken the 90 handle here, but 88% that we'll see no change in January. Okay.
Mm-hmm.
So overall here, I'm thinking no change in January. I'm thinking we just got the last cut for this cycle, and now the Fed is kind of resetting, like the oscillators, resetting. It's at a pretty good stasis, kind of treading water. And I think that's, again, I expected Jerome Powell to be a little bit nervous in this one. He seemed pretty calm, cool, and collected, like they have kind of got to the finish line of something. And now they're resetting and looking across the horizon saying, hey, this economy looks pretty good. Now, there's a lot of things I could say about that. But I do agree generally, if you look at the data and you look at the stock market, you look at the GDP, they look pretty good. The pernicious thing that's hiding under that fact, though, is this chart here. Go back to my screen. Economy grew faster than expected in second half of 2024. Maybe this had something to do with it. It's debt. The GDP is being floated. The majority of the GDP is being floated by government spending. And are they getting that money by selling a profitable service? No, they're debasing the currency and buying things like more tanks, more airplanes, more missiles, and just more hours of labor from state workers, federal workers. That money is trickling into the economy, and GDP is growing. The economy is growing, but how much of that will be taken away if the fiscal situation reaches a fever point? How much of that growth will be taken away if the Fed loses control and inflation starts to tick back up to 3%, 4%, 5%? Will the same powers that be motivated to keep printing and buying and growing the economy? I do not know. All right, so that's my overall take. Yeah, let's check out some of the quotation here from that we just saw. First of which, I'll just repeat this one. Economy grew faster than expected in the second half of 2024. That, again, I just explained why that's not necessarily how the market should interpret it, but it is true. Extent of timing and cuts is not a decision we've made, right? So that's just the classic Jerome Powell speak for we're waiting for the data, as they ought to. Confident in the story about why inflation has come down. Okay, so they believe that their actions have resulted in what I was showing you on the charts, that the inflation has come down because of what they've done, not just the healing of the supply chain after the pandemic. Let's see what else we got. Yeah, so I mean that gives us a lot to chew on there. Tim, anything stick out? There's one more,
No.
and I want to get your take. People feeling effect of high prices, not high inflation. And that's an interesting quotation to pick out there as well. So, what are your thoughts here? What's pointing out to you?
We talked about that last one with Caleb Franzen. People are talking about high prices, and high prices that we have right now are because of inflation. They're not because of recent inflation, right? Here's the thing: is like 2 years ago we made a massive jump in inflation. All right, that is what's making everything so expensive. Last year to now, it's actually very minimal. That's why inflation numbers are not that bad. Is because what we're looking at is data of how inflated are we today from a year ago, right? Not that great, because it's not that big of a deal, because a year ago is when we had the worst of it. You can take that in two different directions. Number one, you can say, oh, that's terrible. That still sucks. Like, well, yeah, prices are not in a great spot. But if we're talking about inflation, this is where I think Caleb gets some flack from some people, and I think he's dead on. If you think that we're ever going to get into a spot where prices dramatically decrease, that's just not going to happen. Prices could fall back a little bit, but a lot of the prices you're seeing right now at the grocery store and at the gas pumps, and maybe gas gets fixed. I think Trump has some solutions for energy and for oil that could make it cheaper. But I think for the most part, a lot of the prices we've seen in the last year, maybe we cool off a little bit, but these are new prices. We're not going to get gas below $1 again. You're not going to get a gallon of milk for 50 cents ever again. These are the things that are not attainable. They're not going to happen. People are going to get ready for it. Well, the only solution at this point is to try to mitigate this inflation as much as possible, and then get the economy in a position where more people get jobs, more people get raises. It's okay if milk is $10 a gallon, but you're making $500,000 a year. That's an extreme situation, but you get my point. We are past the ability to make things cheaper in price dramatically. The only thing we can do is moving forward is try to maintain price and increase wealth and income. And guess what the best way to do that would be? Bitcoin. I mean, it's that simple. The best way to keep people making more money and protect your wealth is to move it into Bitcoin. Protect it. It'll last very long. I know there's some things in here ultimately that it was a lot of nothing burgers, people trying to pin him down, him refusing to be pinned down. Were there moments of hawkishness or negativity? Yes. Were there moments of positivity? Yes. I'm going to continue to kind of say here, Tshroom, I think that Jerome Powell and this decision had very little to do with the pullback that happened. This pullback was more about a market that was overextended. I think there's some people freaking out about, oh, well, this was priced in or this was priced in. I don't think a lot was priced in. I think the only thing being priced in right now is that we had a president for the last 4 years, and we had a whole governmental body that seemed to actively be fighting against the will of crypto investors and fighting against the adoption and the furthering of blockchain technology. And now we have a president, or we will have a president here in the next month, That's going to be the exact opposite. And he's going to promote it. He's going to make it better and he's going to make it easier. That's the stuff that's being priced in. But this is just kind of a good excuse to cool off a very, very hot market. I was looking at Caleb Franzen. He's talking about some different things here. Friend of the channel. Maybe we need to get him on the next day or two before we go away for Christmas break. Look at some of the things that he kind of tweeted here. Oh no, stocks have erased their gains. Oh, May, sorry, you share my screen. Oh no, stocks have erased their gains over the past month. Smells like an opportunity to produce another higher low. That's what people need to remember. Like, I love that he said that. You can take a look at this on Bitcoin. You take a look at a lot of these things. Let's look at Bitcoin. He said stock market, but let's look at Bitcoin. Guys, does this chart, let's get rid of these lines in here. Does that look like a bearish chart? Does that look negative? Does that look like something that is just absolutely terrible? You got to get out of this asset as fast as possible. The answer is no. If I took a look at the stocks, let's look at the S&P 500. That's a pretty dramatic fall for a candle right there, I will admit. But when I zoom out like this, that candle gets very, very small, doesn't it? In fact, we've seen a lot of big dramatic pullbacks during a bull market. But people are acting like they're only watching this chart right here. Let's go to the 15-minute chart. They're only looking at this and they're zooming it in. And yeah, if you zoom in, I can make this chart look really nasty, really bearish, really terrible. But the reality is, if I go like this and I zoom out, this is a blip. This isn't even the largest bearish weekly candle we've seen in recent time. People are freaking out right now, and this is what we're trying to teach you day in and day out about how to read the markets, read the news, but understand there's a composite man out there. There's manipulation happening, and they're going to show you pictures of the 15-minute chart. They're going to look for every excuse they can to make you be negative. But the reality is, when you zoom out, these charts are still extremely, extremely bullish. Anyone who's capitulating right now, who's selling, you probably haven't been watching us for a while. We do not get everything right. I don't want to make sure before I toot our own horn. We make mistakes. There's not a single person out there that has called every top and every bottom perfectly. But I would like to think, if you guys have been watching us for multiple months now, we've been hitting this one pretty good. We've been tracking the movements, not to perfection, but the overall movements, the rallies, the pullbacks, everything else, we've been tracking it pretty well. And the reason why is not because we're these magical geniuses, that we have a crystal ball, that we know everything. It's because we've studied the history of how these things move. We study the details of the charts. We pay attention to the news. We pay attention to which stories are real stories that actually add bullish momentum, and which stories are futuristically bullish, and which stories are just a bunch of hopium and you actually need to trade them oppositely. That's the kind of stuff we do here. That's the kind of stuff we teach in our community over on our Discord every single day. So again, do we get everything perfectly? No, we don't. But we get a lot of things right, and it's about waiting and being patient. And if you're patient, there's some amazing opportunities still ahead of us. Bitcoin, again, I think the first step is 100K. I think we're going down towards lower 90Ks. A lot of arguments for it. Is it going to happen tonight, tomorrow morning? Probably not that quickly. But it's not that's still on the table. But after that nasty pullback, after we see the newer, weaker, I don't want to call them stupid, but let's call them dumber investors who capitulate and say, this is it. Bear market's here. It's all over. When they freak out and leave, that'll be the catalyst for, hey, we hit a bottom. It's time to bounce back up. It's time for the bull market to take off again. I mean, let me show you guys. This is just not something new, and we'll kind of wrap it up here. We're going to have our factoid today with Smay. Got to have our factoid today. Go back here to the history of Bitcoin. The history of Bitcoin bull markets. People freak out. Do you guys see in here the volatility in this bull market? Look at that little blip right there. Does that seem really big? It doesn't seem that big, but guess how big of a pullback it was? 18%. This one right here, it's a little bigger. You guys see how big that one? That pullback right there is over 30%, right? These things are just normal parts of explosive bull markets. I can show you more if I went back here, where again, we had these little blips all throughout the bull market. Is it the bear market? Is the bull market over? Well, we did pull back pretty dramatically, about 40%. We did it once again over here. We had a nice pullback of 40%. But it was nowhere close to the peak. But you want to know how many dumber, newer retail investors capitulated and sold down here in July of 17, sold right here in September of 17, and they missed out on all of this amazing potential. We're witnessing the same thing happening now, people.
Yeah.
We are in the middle of the bull market. We have a long way to go to the upside, and you guys are looking at this chart and you're freaking out.
Here,
And there's
I've got a comparison lined up here. May go to my screen here. I want to show you a tale of 3 charts. All right, the first one is Bitcoin. Notice where it is in this uptrending channel. It's barely breached the midline of that channel. Okay, I want to show you that's Bitcoin spot. Okay, now I want to show you this is gold. Okay, the midline of the channel is here. Where is the price action? It is here. It is breaking below the uptrending line of support. Now, I'm not saying you go out and sell your gold, necessarily. What I'm saying is there's one more chart that I want to show you too. This is the S&P 500 value only, value weighted. What does that mean? It doesn't have Google, Amazon, Microsoft. It doesn't have the big growth companies. This is what comprises this ETF. The ticker is IVE, I believe. IVE. This is the value S&P 500 ETF. It's got names like Berkshire Hathaway, Walmart, ExxonMobil, JP Morgan, Bank of America, Costco, Chevron. These are not companies that you want to fade necessarily, but these are not the growth companies in the NASDAQ and in the S&P 500 that weights it towards growth. Okay. What do we notice about these 2 charts is that they're breaking to the downside, that there is a uptrending line of support in all of them, but they are now trading below that. The same thing for gold, okay? Not as exaggerated. Bitcoin is not breaking that uptrending line of support. In fact, it is barely even breaking the midsection of the trading channel that it's in currently. What is my point? What is your point, Tshroom? There is strength in Bitcoin right now. In this moment of uncertainty, the Bitcoin got a higher bid in its price range relative to other popular assets. What does that tell me? It tells me the summary of the investment world right now is that they want to risk into Bitcoin. They want to sell bonds and they want to buy Bitcoin. They want to buy Bitcoin at a much higher rate than value stocks and gold. That should bode very, very well for any of you who are hodling Bitcoin.
Very, very good. Well, guys, thank you so much for being here with us. Over 1,100 people tuning in on YouTube, concurrently over on X, over 600 were over there with us. Smash that like button. On the way out, we have to do our Factoid today because we want to do a giveaway at the end of the week for the people. So let's bring Smay back on. We'll wrap up the show here in just a couple of minutes. But Smay, really quickly, any thoughts about Jerome Powell you want to add?
Yeah, I just want to say, everybody, smash like for a 2-hour live stream. How about that? We made it, ladies and gentlemen. We made it.
We made it. We're all here. We're alive.
Oh, man, do I love watching Jerome Powell answer questions. Gosh, nothing better. Absolutely nothing better. Anyways, guys, let's go ahead and jump into the Factoid chamber. Boom. The elf cooked up something good for us, and I will take credit for it. Here we go. So, starting off, another crypto-related question. You guys got to rack your crypto brains here.
All right.
The ERC 721 token standard is used for creating what type of tokens? A.
I have no idea.
Fungible tokens. B. Non-fungible tokens. C. Governance tokens. Or D. Utility tokens. Hit you with a little bit of blockchain. A little blockchain.
I legitimately have no idea.
Can I tell you this, Tim? I actually knew this. I knew this. This is something I retained from the Coffin Crypto days.
With that being said, you had moments where you dabbled in NFTs, which makes me say B.
Yeah. I'm going to go that you said that last bit made me think B, and so does that sneaky little smile you got there.
So
hold on real quickly. Here's the don't say Tshroom. We can't both go B because that increases the probability that Smay wins. Smay and the elf win.
I think I'm about to win regardless. But anyways.
All right, that is also another way of making me convinced it's B. I think he's trying to get us to go off of it. I'm gonna go B.
You're right.
My other one I was considering here. Again, if he knew this,
I know you're trying to make a connection to my NFT love, but I also had a big fondness for Polkadot, so I'm just gonna leave it at that.
I understand. You're still trying to shake me off here.
I'm not.
Since you're such a big fan, Tim, of the splitting the vote, why don't you take the D, and I'll go B because B was what I was thinking even before the revelation that we had here.
Fine, I'll go C, governance tokens.
And I'm going to go B. Oh, you're going to go governance? I don't think
Yeah,
it's governance. I think it's D, utility.
Well, then go D.
I think
you
guys just need to both go B and just call it.
I'm gonna go. All right, fine. I'll go D. I'll go with your second choice. I'll go D, utility.
I really
if it
think
ends up being C. If it ends up being C, Tshroom, this is on you.
yeah.
I really
We'll
think you guys should just both go B, and
All
then
right, go
I
ahead.
get $50.
Go ahead, Snake.
All right.
Go ahead,
All right,
Snake.
you ready?
B and D. B and D are our answers.
B and D. Well, ladies and gentlemen, it's
Yeah.
B.
Let's go.
I knew the old classic Snake trying to shake us off the
And
tree.
you know what,
Exactly.
ladies and gentlemen? This is a mild example of few words do better, because I was good until I said that I knew what this was.
Yeah, I was not leaning towards B until you said
I
that.
absolutely shot myself in the foot, guys. So few words are better, guys. You gotta have a better. I gotta have a better poker face if I want to get $50. That's just how this is gonna go.
I love
But
it.
anyways, Tim,
I love it. Just really quick, just as we wrap up, look, if you're having fun with us, we are serious investors and traders. Join us in our Discord where the fun never ends. The chat about crypto and risk assets never end. Just if you're ready to take that next step, go ahead and click this link here, BroLux membership. Come along with us on your trading and investment journey. Don't try to do it alone. Learn from those who have made mistakes. Don't make those mistakes on your own and potentially lose hundreds of thousands of dollars. Learn from those who have already learned those mistakes and can teach them to you. And if you're not ready to make that investment yet, check out our free Discord right here. Where are these links, Tshroom? They're under the video you're watching right now. Just scroll down and they are right here. Free Discord and the paid Discord. Check them out right now.
As we wrap up the show, Tim's thought of the day is one word, ladies and gentlemen. It's patience. The thought of the day is patience. A lot of times people want things to happen just like this. That's the problem with this planet. It's the problem with this world. People want instant results, instant gratification, instant wealth, and that is never, ever, ever going to be your path that works for you. But patience, the ability to wait and strive through the chaos and strive when it's painful and endure even when it feels like you want to quit. Patience is going to be one of the greatest virtues you can have if you want to be successful, not only in investing, but in other places in your life as well. So I urge everybody on your way out, smash the like button, hit subscribe, go be patient. We'll see you tomorrow, same time. Well, 3:00 p.m. Eastern Standard Time. We'll see you there. Adios.